We all see the flashy stuff, right? The hot new product, the viral ad campaign, the sleek office building. But what really makes a business tick? What are the hidden gears that keep the whole machine running for years, maybe even decades? That's what we're diving into today.
It's all about the foundation. Like, what are the things that a company uses to actually generate revenue, not just this quarter, but over the long haul? That's what we're talking about, the core stuff.
And it's surprisingly diverse, this whole landscape. We're going to start with the most obvious, those tangible, physical things, plant assets.
Mm.
Think about a company like FedEx, right? It's their massive fleet of delivery trucks, those gigantic sorting hubs they have, even the land those facilities sit on.
Oh, yeah, totally. But then we got to consider natural resources. Think about a mining company. It's all about those vast mineral deposits they're digging up, right? Those are crucial assets for them.
Absolutely. And then there's the world of intangible assets. These are often invisible, but so powerful. It's the patents that protect a pharmaceutical company's latest breakthrough drug. It's the brand recognition that a company spends years and years building.
Exactly. It's those core elements that really underpin a company's ability to succeed. And the really interesting part for us is how companies actually account for all this stuff. The material we've got for this deep dive is dense, but we're going to distill it down to the most useful, practical knowledge for you.
Think of this as your crash course in business finance. We'll cover the initial costs of acquiring these assets, how those costs get recorded, and then how their value changes over time. That's where depreciation, depletion, and amortization come into play, showing how these resources are essentially used up or worn down.
That's right. We'll also look at what happens when a company sells an asset or when its value suddenly takes a nosedive. And to wrap it all up, we'll look at how savvy investors assess a company's performance in managing and leveraging all of these essential assets.
Okay, so let's start at the very beginning, figuring out the cost of those tangible plant assets.
Yeah.
Where do we even begin?
The core principle here is that the cost of an asset goes way beyond the sticker price. It's every single cost needed to get that asset up and running, functioning for its intended purpose. It's the total investment to make that asset productive from start to finish.
Right, let's take land as an example. You might think, oh, it's just the purchase price, but it's way more than that.
Oh, yeah, for sure. Our sources highlight a bunch of things here, like the broker's commission you got to pay when you buy the land, all the legal fees that come with the transaction, and even the cost of getting a surveyor out there to define the property boundaries.
And here's something you might not think of immediately: back taxes. If the previous owner hadn't paid up, guess what? The new owner often has to cover those, and that gets added to the land's total cost. And this is where it gets really interesting. Imagine there's a dilapidated old building on the land that's got to be torn down.
Oh, yeah, to make way for the new development. So the cost of that demolition, minus anything you might make from selling off scrap materials, actually gets added to the cost of the land itself.
Crazy, right?
It all boils down to getting the land ready for its specific purpose. And our material has a great FedEx example to illustrate this. They might pay, let's say, $300,000 for a piece of land. But once you factor in all those extra costs, like the commission, back taxes, demolition, survey fee, the total cost that hits their books is $324,000.
Right, so those additional costs really add up.
They do. And don't forget about a key point about land. Unlike a building or a truck, it typically doesn't depreciate. Its usefulness generally doesn't decline over time in the same way.
Makes sense.
Yeah.
Okay, now let's move on to buildings, machinery, and equipment. These are like the heavy lifters of a business, and figuring out their cost can be a bit more complex. Let's start with buildings.
Let's say a company decides to construct their own building instead of buying one that already exists.
Right. In that case, the cost includes a whole bunch of things. You have the architect's fees for designing the building. You have the permits you got to get from the city or county. You have the construction contractor's charges.
And let's not forget the materials and labor. It all adds up. You even have to factor in some of the company's overhead expenses, like administrative costs that are related to the construction project.
Oh, and what about interest? If they took out a loan to finance the building, the interest they pay on that loan during construction can also be included in the building's cost.
Absolutely. Now, if a company decides to buy an existing building instead of building a new one, the cost still includes a bunch of things. You've got the purchase price, of course.
And just like with land, you add those brokerage commissions, any sales taxes, and any costs for repairs or renovations to get the building ready for the company's specific needs. Like, imagine a retail store moving into an older building.
They might have to completely gut and remodel the space, and all of that cost gets added to the building's overall cost on their balance sheet. Makes sense, right?
Definitely. Okay, now let's talk about equipment. Think of those sophisticated package handling systems that FedEx uses.
It's amazing how they move all those packages so efficiently. So for equipment like that, the cost starts with the purchase price, obviously. But then you have to subtract any discounts they might have negotiated.
And then you add in things like sales tax, any commissions paid to the salesperson who made the deal, the cost of installing the equipment properly in their facility, and any testing they need to do to make sure it's working right.
Our source even mentions things like specialized platforms needed to operate certain equipment. All those costs get factored in. But here's what's important. Once that equipment's up and running, ongoing costs like insurance, regular maintenance, property taxes, those are treated as expenses for that specific period.
Right, they don't get added to the equipment's original cost. That's a key distinction because it affects how a company reports its profitability each year. Okay, so we've covered land, buildings, and equipment. What about those things that are sort of in between? Land improvements and leasehold improvements, right?
Exactly. So land improvements are things that are physically attached to the land, but not considered part of the land itself for accounting purposes. Things like paving a parking lot, putting up fences or signs, installing a sprinkler system for the landscaping.
So even though they're attached to the land, they have a limited lifespan and they wear out over time. So those costs are recorded separately from the land and they are depreciated. Okay, what about leasehold improvements?
Imagine FedEx leasing a bunch of delivery trucks instead of owning them. Now let's say they decide to paint those trucks with their logo and company colors. That paint job is an improvement that benefits FedEx, even though they don't own the trucks outright.
So those leasehold improvements are considered assets of the lessee in this case, FedEx, and they get amortized over time. Amortization is basically like depreciation, but for intangible assets. They amortize those improvements over either the useful life of the improvement itself or the remaining term of the lease, whichever is shorter.
Makes sense, right? Because once the lease is up, they no longer have the benefit of that improvement.
Definitely. Okay, now here's a scenario. What happens when a company buys a bunch of assets all at once for a single price? This is what they call a lump sum or basket purchase.
Right, like when a company buys a property that includes both the land and a building on it, they need a way to figure out how much of that total purchase price to allocate to the land and how much to allocate to the building.
This is where the relative sales value method comes in. The idea is to allocate the cost based on the estimated market value of each individual asset at the time of purchase. Our source gives a FedEx example from Denver. They bought a property with both lands and a building for a total of $2.8 million.
A professional appraiser determined that the land, if sold separately, would be worth $300,000. The building would have a market value of $2.7 million. So the total appraised value of the individual components is $3 million.
Right, so the land represents 10% of that total value, and the building accounts for the remaining 90%. You then apply those percentages to the original $2.8 million lump sum purchase price.
Exactly. So you end up allocating $280,000 to the land, which is 10% of $2.8 million, and $2,520,000 to the building, which is 90% of $2.8 million.
Okay, that makes sense. Now we need to talk about a really crucial distinction. Capital expenditures versus immediate expenses. It's about deciding whether a cost is a long-term investment that gets recorded as an asset on the balance sheet, we say it's capitalized, or whether it's something that just maintains the asset in its current condition and gets expensed right away on the income statement.
The key question to ask is, does this cost extend the asset's useful life beyond its original estimate, or does it increase its capacity to produce more? If the answer is yes to either of those, it's likely a capital expenditure.
But if the cost is just to keep the asset running as is or to get it back to its previous condition, it's usually treated as an immediate expense. Our source has a great table, Exhibit 7.2, that gives some helpful examples. Ordinary repairs, like fixing a transmission problem at a FedEx truck, changing the oil, replacing worn tires, those are all considered immediate expenses.
Right. They benefit the current period, so they're expensed immediately. But extraordinary repairs are different. Things like a major engine overhaul that adds years to the truck's life, or modifying the truck body for a totally new kind of delivery.
Or even adding a big storage compartment that increases the truck's capacity. Those are considered capital expenditures and get added to the asset's value on the balance sheet. But It's not always black and white, right? There's this idea of materiality.
Oh, absolutely. Most companies take a practical approach. They just expense small costs, maybe anything under a certain dollar amount, like $1,000, even if those costs could technically have a long-term benefit. It's just not worth the hassle of capitalizing and depreciating such small amounts. But for larger, more significant costs, that distinction is crucial.
Right, because it can have a real impact on a company's financial picture.
Yeah.
And unfortunately, this is where things can get messy. Sometimes there are errors in how these costs are classified. Sometimes it's intentional fraud. Our source mentions how misclassifying costs, whether accidental or deliberate, can distort a company's financial statements.
Absolutely. And it can lead to either understating or overstating expenses, which directly impacts net income. And of course, it can misrepresent the value of assets on the balance sheet. And a really sobering example of this is the WorldCom case. It was a massive accounting fraud.
Yeah, it wasn't just a couple of misclassified items. They deliberately capitalized billions of dollars in line, costs the fees they paid to other companies to use their networks. Those were clearly operating expenses that should have been expensed right away.
Right, but by classifying them as property, plant, and equipment, they made their assets look way bigger and inflated their profits.
It was a huge scandal that led to WorldCom's bankruptcy, billions in losses for investors, and the loss of tons of jobs. And it had a ripple effect throughout the business world, leading to the passage of the Sarbanes-Oxley Act of 2002. That law was designed to strengthen corporate governance and protect investors from this kind of fraud. So it's a stark reminder of how important accurate accounting for these long-lived assets really is.
Absolutely. Okay, so now that we got a grasp on how companies initially record the cost of these assets, let's move on to how that value is recognized as being used up over time through depreciation.
Depreciation is an essential accounting concept. It's the systematic process of allocating the cost of a plant asset over its useful life. Basically, it's matching the expense of using the asset with the revenue it helps generate during each accounting period. And the book value of an asset, the amount it's carried at on the balance sheet, is just its original cost minus the accumulated depreciation up to that point. One thing to remember is that depreciation is just an accounting concept.
Right. It doesn't mean a company is actually setting aside cash to replace the asset when it wears out. Those are separate financial decisions. To actually calculate depreciation, we need three key pieces of information. The asset's original cost, which we already talked about, its estimated useful life.
And its estimated residual value, also known as salvage value. That's what the company expects to get from selling or disposing of the asset at the end of its useful life.
Exactly. While the cost is a solid number, the useful life and residual value are just estimates based on experience, industry data, and educated guesses about the future. Now, there are three main methods that companies use to calculate depreciation: the straight line method, the units production method, and the double declining balance method.
Straight line is usually the simplest. You take the asset's depreciable cost, which is its cost, minus the residual value, and divide that by the asset's estimated useful life in years. That gives you the same depreciation expense for every year of the asset's life. Our source uses a FedEx delivery truck example. Let's say the truck costs $41,000, has a residual value of $1,000, and a useful life of 5 years.
So first, you find the depreciable cost, which is $40,000. That's $41,000 minus $1,000. Then you divide that by the 5-year useful life, and you get an annual straight-line depreciation expense of $8,000. Exhibit 7 to 5 in our source shows a depreciation schedule for this.
It shows you the $8,000 depreciation expense each year, the accumulated depreciation going up by $8,000 each year, and the book value of the truck gradually going down until it hits that $1,000 residual value at the end of year 5. There's even a try-it example with a sorting machine to practice this.
Yeah, that's helpful. Now, the next method is units of production. This one focuses on the actual usage of the asset, not just the passage of time.
So instead of years, you think about miles driven, units produced, hours of operation, things like that. You calculate a depreciation rate per unit. So for that FedEx truck, it would be per mile driven. To get that rate, you take the depreciable cost and divide it by the total estimated miles the truck will drive over its useful life. Then, each year, you multiply that rate by the actual miles driven to get the depreciation expense for that year.
Going back to the FedEx truck, with a depreciable cost of $40,000 and an estimated total life of 100,000 miles, the depreciation rate per mile would be 40 cents. In a year where the truck drives 30,000 miles, the depreciation expense would be $12,000. Exhibit 7 to 6 shows how this can fluctuate each year depending on how much the asset is used. It's a good method for assets that wear out more from use than just from getting older.
Right. Okay, lastly, we have the double declining balance method. This is what's called an accelerated depreciation method.
Yeah.
It means you recognize more depreciation expense in the early years of an asset's life and less in the later years.
The formula for this one is a bit different. You find the straight line depreciation rate as a percentage that's just 1 divided by the useful life in years. Then you double that rate. You multiply that doubled rate by the asset's book value at the beginning of the year to get the depreciation expense for that year. Now, here's a key point with double declining balance. You ignore the estimated residual value when you're calculating depreciation for the early years, but you can never depreciate the asset below its residual value. So in the final year, the depreciation expense is whatever amount is needed to bring the book value down to that residual value. They call it a plug amount. For the FedEx truck with its 5-year life, the straight line rate is 20%. Doubling that gives us a double declining rate of 40%. So in the first year, the depreciation expense would be $16,400, which is 40% of the truck's initial cost of $41,000. Exhibit 7 to 7 and the try it problem on page 377 show how this works year by year.
Right. It's interesting to see how these methods play out over time. Exhibit 7 to 8 in our source shows a nice comparison of all three methods for the FedEx truck example. You can see how the annual depreciation expense is different, especially in those early years. But the total depreciation over the 5 years is the same for all three methods, $40,000, which is the depreciable cost. There's even a practice problem to test yourself on identifying which method is being used.
It's a good exercise. It emphasizes that although each method allocates the cost differently over time, the total depreciation recognized over the asset's life is always the same. It's that depreciable cost. The choice of method really just affects the timing of when the expense is recognized in the company's income statement.
Okay, so now there's an interesting wrinkle when it comes to depreciation for tax purposes. Our source says companies often use straight-line depreciation for their financial statements, the reports they give to investors and creditors, because it makes earnings look more stable over time. But for calculating their income taxes, they might use accelerated depreciation methods like double declining balance.
That's a really important point. Why do they do that? Well, accelerated depreciation means a higher expense in the early years, which translates to lower taxable income and less income tax payable in those years. It's a totally legal and ethical way for companies to manage their tax burden.
It's about timing those cash flows, right? Exhibit 710 shows this with a FedEx office building example. Using double declining balance in the first year results in a lower tax bill and higher net cash flow compared to straight line. But just like with capitalizing asset costs, estimating useful lives and residual values can be tricky and open to manipulation.
Oh, yeah, for sure. Our source brings up the waste management case, where they got into big trouble for intentionally inflating the salvage values and extending the useful lives of their garbage trucks.
Yeah, that reduced their depreciation expense each year and made their profits look way better than they actually were. It's a classic example of how seemingly small accounting estimates can have a massive impact and a reminder of the importance of ethical accounting.
Absolutely. Now, we've covered how to account for the initial cost and the depreciation of plant assets. But what happens when a company decides to sell one of these assets? How do they handle that?
So first of all, they got to make sure all the depreciation is recorded right up to the date of the sale. Then they calculate the asset's book value at the time of the sale, that's the original cost, minus all the accumulated depreciation. Then they compare the selling price, the cash they get, to the book value. If the selling price is higher, they've got a gain on the sale. If it's lower, they have a loss.
Right. These gains or losses get reported on the company's income statement. The source gives an example. FedEx sells a piece of equipment for $7,300 cash. It originally cost $10,000 and has accumulated depreciation of $3,750. So the book value at the time of sale is $6,250. Since they sold it for $7,300, they have a gain of $1,050.
That gain gets added to their net income for that period. Okay, our source also mentions T accounts. They're these visual tools that can help analyze transactions involving plant assets. By tracking the increases and decreases in asset costs, accumulated depreciation, cash from sales, and those gains or losses, you can get a clearer picture of what's going on.
You can figure out how much a company spent on new assets, how much they got from selling old ones. There's even an example showing how to calculate the original cost of a building that was sold just by looking at the changes in the related T accounts.
Pretty cool. Now let's talk about some of the differences in how these assets are handled under U.S. GAAP. Those are the accounting rules generally used in the United States, and IFRS, which is used in lots of other countries. Under GAAP, plant assets are usually recorded and kept on the balance sheet at their original cost, minus depreciation, of course.
Right. It's called the historical cost principle. The idea is that historical cost is more objective and reliable because the original purchase price is a verifiable fact. IFRS is a bit different. They give companies the option to revalue their plant assets to their current fair market value.
The argument there is that the original cost of an asset bought years ago might not reflect what it's really worth today. So revaluation is meant to give a more up-to-date picture of the company's assets.
But there are downsides to fair value. It can be subjective and fluctuate wildly with market conditions. Remember the 2008-2009 real estate crash? Property values plummeted. If assets were constantly revalued, it could really make a company's balance sheet look unstable. So while IFRS allows for revaluation, GAAP prefers sticking with historical cost for its reliability. Okay, enough about plant assets. Let's move on to natural resources, another type of long-lived asset. What are we talking about here?
Natural resources are those assets that are consumed or depleted as they're used. Think timber forests, oil and gas deposits, mineral deposits.
And the accounting process for these is called depletion. It's how you allocate the cost of those resources to expense as they're used up. It's pretty similar to depreciation for plant assets.
The formula for depletion is a little different, though. You start with the total cost of the resource property. That includes the purchase price, but also any development costs to get the resource ready for extraction.
Right, like the cost of drilling oil wells or digging mine shafts. Then you subtract any estimated residual value, what the land might be worth, after all the resources are gone. Divide this total depletable cost by the total estimated units of the resource, like barrels of oil or tons of ore. That gives you a depletion cost per unit.
Then, each period, you multiply that per unit cost by the actual number of units extracted to get the total depletion expense. The source has an example with Pacific Energy Company. They buy mineral rights for $3 million and incur additional costs to prepare the site for mining. These costs bring the total up to about $3.19 million. Engineers estimate there are 240,000 tons of recoverable ore, so the depletion cost per ton is about $13.28. As Pacific Energy extracts and sells the ore, they record depletion expense based on how much they sell, and that expense becomes part of their cost of goods sold.
Makes sense. Now let's get into intangible assets. These are the assets you can't see or touch, but they can be incredibly valuable.
So what are we talking about here?
Intangible assets are things like patents. Those give you the exclusive right to produce or sell an invention. Then there are copyrights, which protect creative works like books and music, and trademarks and trade names, those logos and brand names that distinguish a company's products.
And we can't forget about franchises and licenses, those agreements that let you operate a business under specific conditions. And then there's goodwill, that somewhat mysterious asset that comes up when one company buys another.
It can be tricky to wrap your head around goodwill sometimes. We'll get into that. The important thing to remember is that intangible assets fall into two categories: those with a limited useful life and those with an indefinite useful life. And this makes a big difference in how they're accounted for. Intangible assets with a limited useful life, like patents and copyrights, are amortized over their useful life, or their legal life if that's shorter.
Amortization is basically depreciation for intangible assets. You're systematically expensing the cost of the asset over its useful life. They usually use the straight line method for this. And for some intangibles, like patents, the amortization expense can be credited directly to the asset account, reducing its value, instead of creating a separate account like accumulated depreciation.
Right. But intangible assets with an indefinite useful life, like a super well-known trademark or goodwill, are not amortized. Instead, they're checked every year for impairment, a big, unexpected drop in value.
Okay, let's look at some examples. In the U.S., patents usually last for 20 years from the date they're filed. If a company develops a patent in-house through their own R&D efforts, they can only capitalize the legal and registration costs. All the R&D costs that led up to it are expensed right away. But if they buy a patent from someone else, they can capitalize the whole purchase price and then amortize it over its remaining legal life or its useful life, whichever is shorter. The source gives an example of Sony buying a patent for $170,000 with a 5-year useful life. That would mean $34,000 in amortization expense each year.
Copyrights can last a really long time, often for the life of the author plus 70 years. But in terms of making money, their useful life is usually much shorter. The accounting for purchased copyrights is similar to patents. You capitalize the cost and amortize it over its useful life. Now, trademarks and trade names can be tricky. Some have a definite life if they're tied to a contract, and then they're amortized. But a lot of famous trademarks, like McDonald's Golden Arches, are considered to have an indefinite life.
because they can theoretically use them forever and they're expected to keep generating revenue indefinitely. Those indefinite life trademarks aren't amortized. They're just checked for impairment. Same idea with franchises and licenses. If they're indefinite and expected to provide ongoing benefits, they usually aren't amortized.
Okay, now for the tricky one, goodwill. This only comes up when one company buys another. It's basically the amount that the buyer pays above the fair value of the identifiable assets they acquire. Like imagine FedEx buys Europa Company for $10 million. Europa's net assets minus liabilities, are worth $7 million. FedEx would record $3 million in goodwill. That $3 million represents the premium they paid above and beyond the value of Europa's assets. It's not amortized, but it is tested for impairment each year. One more thing about intangibles. Research and development costs R&D are usually expensed as they occur under U.S. GAAP. That's because the future benefits are uncertain. IFRS is a bit different. They might let you capitalize certain development costs if you can show they'll have future economic benefits.
Okay, so we've seen how tangible assets lose value through depreciation, natural resources get depleted, and intangible assets with limited lives are amortized. But sometimes an asset's value takes a sudden hit. This is where impairment comes in.
Impairment happens when the expected future cash flows from an asset are much lower than its book value. This might be because of damage, a change in the law or the market, or the asset becoming obsolete. Remember the pharmaceutical patent example. If a drug turns out to be dangerous, the patent's value plummets.
To deal with impairment, there's a two-step process. First, the impairment test. You compare the asset's book value to the total of its estimated future cash flows. If the book value is higher, that suggests impairment. Then, if the test points to impairment, you calculate the loss. The loss is the difference between the book value and the fair value of the asset's market value at the time of the test. The source gives a FedEx example. An asset has a book value of $100 million. Market conditions change, and FedEx now estimates the future cash flows will only be $80 million. The fair value is estimated at $70 million.
Because the book value is higher than those future cash flows, the asset is considered impaired. The impairment loss is $30 million, the difference between the book value and the fair value. That loss gets reported on the income statement, and the asset's value on the balance sheet is written down to $70 million. Under U.S. GAAP, once you write an asset down for impairment, you generally can't write it back up later, even if its value goes back up. IFRS is a bit different. They might let you reverse impairment losses for certain assets.
Okay, let's switch gears a bit and talk about how investors figure out how well a company is using its long-lived assets. One important metric is the rate of return on assets, or ROA.
ROA measures how efficiently a company is using its assets to generate profits. You calculate it by dividing net income for a period by the average total assets during that period. A higher ROA usually means the company is doing a good job turning its assets into profits.
The source talks about the DuPont analysis, which breaks down ROA into two parts: net profit margin and total asset turnover. Net profit margin is how much profit they make for each dollar of sales. Total asset turnover is how efficiently they're using their assets to generate sales.
It's a powerful tool. By looking at both of those components, you can get a much better sense of what's driving a company's profitability. Like, a company with a high net profit margin but low asset turnover might be selling high-priced, unique products with strong brands, like Apple. But a company with a lower margin and high turnover might be selling tons of cheaper products, like Dell in some of its segments.
The source gives an example of Ambrosia Corporation. They had $100 million in sales and $18 million in net income, with average total assets of $200 million. That gives them an ROA of 9%. If you then look at their profit margin, which is 18%, and their asset turnover, which is 0.5, you start to understand their business model and how effectively they're using their assets to make money.
It's a valuable insight for investors. Finally, let's touch on how these long-lived assets affect a company's statement of cash flows. Buying and selling these assets are considered investing activities.
So when a company spends money on new plant assets or makes big improvements to existing ones, those are capital expenditures. Those are cash outflows in the investing activities section of the statement. But when they sell off old assets, the cash they receive is a cash inflow in the same section.
Depreciation, depletion, and amortization, even though they reduce net income, don't involve an actual outflow of cash in the current period. So when you're putting together the statement of cash flows, you add those back to net income. Exhibit 713 in our source shows part of FedEx's statement of cash flows. It highlights their capital expenditures, the buying and selling of assets, and that adding back of depreciation. It gives a clearer picture of how all these activities affect the actual cash moving in and out of the business.
Okay, wow. We have covered a ton of ground in this deep dive into long-lived assets. Before we go, let's quickly review the key takeaways.
We started with how to figure out the cost of plant assets, remembering to include all the necessary expenses to get them ready for use. We talked about the three main depreciation methods: straight line, units of production, and double declining balance. Then we covered depletion for natural resources, amortization for intangibles with a limited life, and the concept of impairment when an asset's value drops suddenly.
And we wrapped up with how ROA and the DuPont analysis help investors evaluate how well a company uses its assets. And we talked about how these asset transactions show up on the statement of cash flows.
Exactly. And it's crucial to remember that these aren't just abstract accounting rules. They're the foundation of how businesses work, how they report their finances to the world, and how investors decide where to put their money.
Understanding these principles is super valuable, whether you're managing a business, analyzing investments, or just trying to understand the bigger economic picture.
So next time you see a business or think about a particular industry, consider those long-lived assets they depend on. Think about how the concepts we discussed today might shed light on their operations and their financial health.
And to leave you with something to think about, since companies have options for how they depreciate assets, and these choices affect their reported earnings and their taxes, how might a company choose a depreciation method that aligns with their financial goals and their tax planning? It's a fascinating question to ponder as you continue to explore the world of business and finance.
Absolutely.
Thanks for joining us for this deep dive. We always appreciate your feedback and any ideas you have for future topics. Until next time, keep exploring, keep learning, and stay curious.
We'll see you then.